to Nirmal Bang, ladies and gentlemen. I'm Hiral Dadia. We have with us Mr. Saugata Bhattacharya, Chief Economist at Axis Bank, joining in. Welcome to the show, Saugata, and a pleasure to speak to you, and really happy to see you as well. And, I mean, when you're unwell, you've come to speak to us and get a little information to all the viewers as well. So hoping that you get well soon. But my first question coming to you, Saugata, is with regards to where the GDP goes. 20.1% is what we saw in the first quarter of FY22, and that was slightly weaker than what the consensus estimates were looking like. Do you think it is still too early for the government to ease government support, taking the GDP numbers that have come in? And what's your view of the number?
So one is, as you said, slightly weaker than markets had expected, a bit more weaker than what we had expected. We had expected in the range of 24-25%. Particularly given the construction sector, steel, cement, which are the proxies that we use for consumption, construction. So we had expected slightly, because steel, cement consumption was very, very high during the quarter. So given this, our sense is that we had been at 9.5 for the full year, 9.5% YOY growth. And we were just about beginning to take it slowly up to about 9.8, 9.9, 10% or so. But we'll have to wait and watch now with whatever we have seen. Your second part of the question, that can the government relax now? I mean, can it? Absolutely not. I think demand still remains a big problem. Consumption remains a problem. So I mean, this needs to be interpreted very carefully, because consumption in this first quarter is actually just about the levels of 2017-18. 4 years back. I mean, almost at that level. Of course, you have to recognize that this quarter, because of all the public health restrictions, the lockdowns, etc., even though restricted, was an unusual quarter, remained an unusual quarter. For this year, for the full year, we will probably cross 2019-20 the full year, the consumption part. But that is dependent on the government spending. Because I do believe, although data is scarce, so we use a mishmash of data from various sources, we do believe that consumption has taken a hit. A large segment of the population, particularly a large segment of the production population, the micro, small, even the medium businesses, they have been hit severely, because when the cash flows have been disrupted, medical fees, medical expenses, etc., have gone up. So it is this segment that I think needs to be targeted. The large mid and the large corporates are doing very well. I mean, they're resilient, they're agile, and they've shown that they can get into this. And anyway, given the consolidation that is happening in the face, which is what the outcome of which you're seeing in the equity markets, stock markets, I think the government now needs to focus on targeting, maybe through capex, maybe not just handouts or whatever, maybe capex. Because capex will essentially ultimately trickle down, percolate down to the companies, subcontractors, etc. So that will come in. The good news is that the government's revenues in the first quarter, then going into July, the latest numbers that we have seen, still remains very robust. So they have the room to spend. On top of which, the asset monetization plan, the other disinvestment proceeds, etc., might give them even more room. I know that the government is very clear that they do not want to breach the fiscal deficit target. They do not want to increase their market borrowing program. But be that as it may, I'm a little, puzzled why the government still seems to be not spending the money that it apparently has. Because we track this as a proxy through something called, they keep their balances with the Reserve Bank of India.
Right.
That level is still above 3 lakh crores. So why that is not getting drawn down is a bit of a puzzle. But I think the government has a huge role to play in stimulating demand.
Right. So overall, Saugata, yes, there was some bit of support that came in from the government capex front as well in terms of the GDP, apart from the low base. However, if you see the government expenditure, that seems to be coming under pressure right now, even on the capex side. Do you think that could act as a drag on growth if this trend sustains?
Well, I mean, the part on the capex, on spending on capex, it's not easy to spend on capex just like that. I mean, capex as unlike consumption, where you can just roll out amounts, subsidies, interventions, subventions to various targeted segments of the population. CapEx has to work on a plan. So you can't just say that, a road project or a pipeline project or the irrigation project. You can't just say, I'm going to increase expenditure on this or whatever. You can't. Because there has to be a project feasibility report. There are stages of the project. There's a construction phase. So whatever projects are in line, there are pipeline constraints in many of the construction projects now with these bottlenecks that have cropped up in getting spare parts and getting equipment, etc. So all of that. So getting money into capex, driving money into capex is not very simple. It has to be done in a planned manner. But I hope with the lead time of the next 2-3 months, etc. I really hope that the capex pipeline gets into play. And particularly remember that over the last 4 or 5 years, the large part of the capex, government capex, has come in from the states. And states, despite getting a windfall from their petrol and diesel taxes, the sales taxes, still don't seem to have enough revenue because the other sources of revenues have been hit. So they are dependent to a very large extent on the government transfer, on the center's transfer to the state government. And that is something that I think the states, the center should coordinate with states to figure out which states are ready with their capex programs, etc., and begin to push money into those states. Besides which, any payments that are due to vendors, to contractors, etc., those I think need to be cleared off very, very quickly because cash flows become a problem. And of course, there are other incentives like the ECLGS, variants of ECLGS for credit in delivery to the MSME sectors, for instance. Those need to be looked at very carefully, and probably the scope needs to be expanded. ECLGS 5, which expanded it to 4.5 lakh crores, I don't think still hasn't got the kind of traction that the previous editions of the ECLGS have. So we need to figure out why, what's the problem, what are the bottlenecks, and then see. So credits, state spends, center spends, everything needs to come together to get this capex pipeline used.
Right. And how important and effective is the national monetization pipeline going to be that has been recently unveiled? Do you think that's going to be the middle of the road approach to monetize public assets?
Well, middle of the road in the sense that this is not an outright sale, as the government has been very clear in expounding that these are not asset sales. So there's one part which is the divestment, disinvestment pipeline, which has been BPCL, part sales in LIC, etc. So that's one part. I frankly think that all of us economists for the last couple of years have been shouting from the rooftop to anybody who cares to listen that look, you have a huge amount of assets that are in play, and say for instance the road assets, the InvITs program. That's exactly the way to go. So operational projects with revenue visibility and things need to be handed off because most private sector contractors or concessions will not touch construction risk in the project. So that needs to be done by NHAI, PGCIL, whatever the government entity is. And they need to generate resources. So anything which is viable, which is revenue, cash generating, needs to be handed off to the private sector, offshore players, domestic players, whatsoever. The point to note in this is that the regulatory and the governance frameworks in this asset monetization needs to be looked at very carefully. There should not be a concentration of assets within a few players. Because that oligopolistic, it makes sense in a road project because it's a network. So, you cannot have fragmented stuff. But that's what needs to be, the government needs to spend a lot of time to figure out how to distribute the assets within a diverse set of players, offshore, onshore, domestic, etc. So that effective control is still dispersed amongst the private sector.
Right. So overall, with growth, Saugata, what is your view on inflation? Do you think there could be concerns about sticky inflation from here on?
Well, inflation is sticky. There is no doubt about that. That for some part, the way that we calculate inflation with base effects and things, I wish we transited at some point in time to a month-on-month, seasonally adjusted, just like the rest of the world does. But we still have some ways to get there. So inflation for the next quarter is going to come down because of the base effect of the last quarter, the same corresponding quarter last year. say 5.4, probably less than 5 for the next 2 months. This inflation is going to come in at probably about 5.6 or 5.4 or wherever. So the next one will probably drop down to around about 4.5%, 5%. But after that, in Q4, it's going to go up again. Now, this needs careful consideration because as of late, global data seems to be creative, particularly China. So as a result, metals like copper, nickel, etc., those have come down fairly significantly. But there are many other, as we talked about, the bottlenecks in the shipment. Say for instance, the containers are not available, ships are not available, ships are not available. So all of these and freight rates have gone through the roof, and this is likely to persist for some time because things have gotten very concentrated in a few trade corridors, East Asia to the Western Pacific parts of the US, etc. There are a lot of empty containers need to come back. And so those are things that we need to work on to get these costs down. My own sense is that inflation, we continue to look at this very, very carefully. That, if inflation remains persistent, that means the demand is more resilient than we otherwise expect. On the one hand, we say that there's been a big hit on demand, and particularly small, medium consumers, industries and consumers, etc. On the other hand, demand, particularly demand for not just discretionary, even other demand, still remains very strong. So we need to get a sense of, is demand resilient, or is this something which is more supply driven and is likely to come back over a period of time? So as of now, the RBI MPC will probably need to factor in about, as you know, the average inflation about 5.4 for this year. It's still a little uncomfortably high. But I think overall, I think they need to live with this level of inflation for a 6 months, 10 months or so, because prioritizing growth, I think, is important. Of course, it's a very, very difficult balancing game for them. A very difficult balancing game for them because globally, taper is going to start initially with the Fed, then with the ECB. They're waiting for the ECB the meeting on Thursday to see how they are going about it. But this balancing, the tightrope that they will have to do is very, very difficult. But the RBI has shown that they're capable of doing this. So fingers crossed again on this, that rates would probably still remain relatively low. Although I'm sure that over the course of this year, probably in Q4, the reverse repo rate will start climbing a little gradually higher, creeping higher.
Right. So are we trying to say that in spite of the bank credit growth and the deposit growth, which has almost nearly remained steady, and the credit growth that we've seen has continued to be led by personal loans, still for some time from here on, the rates will largely remain anchored? Is it right to say that?
For the next few months, I think rates will remain anchored. Yeah. So one part of the rates remaining, the short-term rates, overnight rates, short-term rates remaining low, is this flood of liquidity. It's over 9 lakh crores now with the government spending at the beginning of the month, with all the IPO flows coming in, the other autonomous flows. The government will start spending, as 3 lakh crores still with the Reserve Bank of India. So all of this will easily drive up system liquidity to about 10 lakh crores. The RBI governor, as you know, in the last couple of interviews, he's mentioned fine-tuning operations other than the variable rate reverse flows, etc. So they will manage this, but it's becoming increasingly difficult how to do this because there are multiple. With the forex rates, do you sterilize spot forex flows? Do you work in the forward markets that will push up the forward rates, etc.? So again, multiple dimensions of how they. But together, point one is that rates will probably start going up in late in Q3 and probably in Q4. Not too much, but they're going to start creeping upwards. Credit growth is a problem. Credit is still fairly, and retail, which has been, as you mentioned, the driver of credit growth, whatever else remains, the retail driver. Banks, I think, will be very careful in pushing retail beyond a certain point. Till things stabilize, till banks understand the risk, the evolving risks around credit. So credit growth is very. Remember, for the large corporates, they have diverted to markets, capital markets. So they are raising rates at very, very cheap domestic, offshore, etc., and paying down loans, paying down their existing bank credit. But for the others, the mid corporates, the small corporates, etc., this is going to be the problem, other than retail. And that, with a gradually creeping up of shorter term rates, will need to be looked at very carefully.
Right. So, Saugata, overall, if you see in terms of where the liquidity picture goes right now, do you think the focus will be on managing the surplus liquidity right now, which is likely to keep increasing and it's already at very high levels?
That's the only way. I mean, when we talk about a normalization, when we talk about getting out of this accommodative stance, they're not going to go out of this accommodative stance explicitly anytime soon. So they're going to maintain the accommodative stance. You've already seen one MPC member dissent on that. But normalization is going to happen. And normalization, what do we mean by normalization? Normalization is managing this huge amounts of liquidity in the system. So they've already increased till the end of the September, together with the 4 lakh crores of fixed rate repos, then there are these variable rate repos, there are these fine-tuning operations. I'm sure they will introduce some more instruments too. They will need to do that. But together with this, I mean, as they push the variable rate reverse repos out from 14 days to 28 days, maybe a little bit more than that, cost for the Reserve Bank, and the signal from the Reserve Bank is that rates will begin to creep up. So managing liquidity means managing both the quantum of liquidity, which is the 10 lakh crores that they will face, plus the price of liquidity. So both the quantity and the price of liquidity will need to be managed to give an effective signal that normalization is underway, although there are no explicit signals coming in from that direction.
Right. And very lastly, Saugata, overall with regards to where the fiscal deficit goes, now we've reached 21.3% of the full year target, and we've pegged the fiscal deficit at 6.8% of the GDP as per the government. Do you think this is something which is achievable, or do you think that the government could actually do better than the projections?
Given the current state, so one, they're not going to breach the 6.8, come what may. So they have now the space, the fiscal space, particularly with now, if something happens to the bond inclusion, if they manage to get the LIC IPO going, running, etc., they have the space now to try to reduce it. My own sense is they were also not going to do that too much. I think they're also very seized with the fact that they need to spend, both by transfers to the state and spending directly. So I think they're going to stick to their 6.8 target, and at the same time, so given the better than expected, better than budgeted revenues, tax revenues, direct taxes, GST taxes, etc., plus all the other non-tax revenues, investment, monetization, IPOs, etc., they will have the room and they will use that room to spend. The puzzle over here is why they're not spending immediately, because previously, a couple of months back, we were saying that, I mean, with the lockdowns and things, they were waiting for an opportune moment. There's no point in spending during a lockdown that people not spend. But now I think the time has come for them to start spending fairly heavily, judiciously, part in capex, part in consumption, but they need to start spending.
That overall seems to be a slightly better picture from here on. Thank you, Saugata, so much for joining us on the show, and really appreciate you joining us in spite of being ill. Please take care, stay safe, and praying that it's not COVID for you as well.
Great, absolutely. Always a pleasure to be on your show.
Thank you. Thank you.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.